I'd like to welcome everyone this morning to the 2022 Lawrence Housing Market Forecast with Dr. Stan Longhofer. And his theme, I noticed, is space. And kind of fits in with current events. Yesterday, a well-known actor, fictional spaceman, William Shatner, went into space yesterday. And I was thinking, if Dr. Longhofer was ever in an episode of Star Trek, he'd say, "Damn it, Jim, I'm not that kind of doctor." But the kind of doctor he is, he's a professor of the Stephen L. Clark Chair of Real Estate and Finance, director of the Wichita State Center for Real Estate. He is the founding director of the Center for Real Estate, and in his role provides research services and educational programs to real estate professionals throughout the region, and is the author of the Center's annual Kansas Housing Market Forecast, which is what we're here today doing. His insights regarding real estate market conditions are widely quoted in local and national media outlets, including The Economist, Forbes, USA Today, and the Christian Science Monitor. He has been featured as an op-ed columnist in Washington Post and the Wall Street Journal's online edition. Dr. Longhofer's research has been published in a number of leading academic journals. In addition, he has written numerous popular articles on real estate and financial markets that have appeared in publications such as the Investor's Business Daily, the Cato Institute Regulation Magazine, and Commercial Investment Real Estate. Prior to coming to Wichita State, Dr. Longhofer was a financial economist with the Federal Reserve Bank at Cleveland Research Programs in Mortgage Discrimination, Financial Contracting, and Bankruptcy. While there, he also served as a founding member of the Federal Reserve System's Fair Lending Advisory Group, consulting with bank examiners on fair lending issues and developing statistical techniques to uncover mortgage discrimination. He has earned his MS and PhD degrees in economics from the University of Illinois and holds a BBA from Wichita State. Everyone, Dr. Stan Longhofer.
Well, thank you so much. It is such a delight to be here. Great pleasure to be in Lawrence. And where was I? Was it you, Rob, or somebody who asked me when I went someplace and I said, "Oh, I'm so happy to be here and I love coming here," and said, "Do you say that to everybody?" Well, I do say that to most people, but I really, really mean it when I come to Lawrence. You all have a wonderful. Am I getting a little bit of better closer or better farther away? So about the same. Okay. I do have a really special place in my heart for the Lawrence Board of Realtors. So when we started, I went back and looked, it was 2010 that we first began expanding our forecast outside of Wichita to the rest of the community. And Rob and the board here in Lawrence really embraced it as just a wonderful, wonderful thing to do. And it sort of blew my mind of wow, here I am in KU land, and you're welcoming somebody from Wichita State. And so that was a wonderful thing, and I really appreciate it. As he said, this year's theme, when I started working with my graphic designers and talked about, okay, so what do we want to do this year? I always like to have a theme, something that we can tie in with some of the text and the other things. And so we get together, and the first thing my graphic designers asked me is, what's going on in the market? What do you think the forecast will be this year? And I said, wow, this market is just out of this world. Oh, I guess that's this year's theme, isn't it? And so we had a really fun time with the space images, the Hubble telescope, and take the time as you go through the publication to look through some of the little factoids. My graphic designers had a lot of fun in looking up a lot of things about some of the different satellites. And as you go to, I think Voyager is what we have for Lawrence, but as you go to look at the other markets in the forecast, it's a different satellite and different images that you have. So a lot of fun with that. And we would not be able to put together this beautiful publication and have it available for you if it was not for the generous support of Security First Title and Ameritrust Credit Union, who are the sponsors of the Lawrence Housing Forecast this year. They've been friends for many, many years, and we're really grateful for the way they engage the community. And so please let them know that you appreciate it. And you will notice as you walked in that there are lots and lots of copies there on the table, and Rob would really appreciate it if he doesn't have to take them all back to the office. And the reason we print so many copies is that we found many, many realtors find these to be really useful to include in listing presentations, to include in relocation packets and other things. It's just an additional resource that you can provide. So please feel free to take as many copies as you want. If we end up running out, let Rob know, and next year we'll make more. We try to be judicious and estimate the right amount, and I think we're there, but if we're wrong, let us know and we'll get that fixed. So I also need to thank all the partnerships that we have, not just with the Lawrence Board of Realtors, but with realtor systems across the state. Like I said, starting in 2010, we began a contract with the Kansas Association of Realtors where we access all of the multiple listing services across the state. And you all use different vendors, so the form of the data and everything is different. We make that all talk to each other and put it together so that we have statewide housing statistics that would not be available otherwise. So we do that, and as a part of that contract then, we're able to provide back to you the monthly MLS statistical reports. And if you've seen them yet that came out this month, they came out earlier this week, we have a brand new design for those MLS statistical reports, and they're really beautiful, easy to read. I think you'll really like them. And they're also specifically branded to the Lawrence Board of Realtors. So I think it's been a big addition, and we're grateful for this partnership that we've had. So enough of the preliminaries. You want to know what's going on, and when Rob heard my presentation last week at the Kansas Association of Realtors, he said, some of the things you talked about the economy were really interesting. Are you going to do that here? And I said, absolutely. I was already planning on it. And so, we often think about the economy and we think about the unemployment rate, right? That's often the headline thing we think. Do people have jobs, and are they working or not? And so I think I'm going to move back here because then I'll be less likely to create some problems with that. Hold on. Just put that here, and hopefully everybody's still able to hear me okay? Super. So we have unemployment rates, and you can see, of course, all the numbers are just totally skewed by the pandemic. We had these sharp increases in unemployment rates. Lawrence was relatively better than some other parts of the state, but still had unemployment rates that jumped up around 13%. Since then, they've come back down almost to pre-pandemic levels. Okay, so the unemployment rate is now almost back to where we were previously. And certainly what I think many economists would think of as being very close to full employment. But there are two ways we look at the labor market. One is by looking at households. We ask people, and we phone them up and we say, do you have a job? Do you have a job? Oh, you don't have a job? Are you actively looking for work? And the unemployment rate is the percentage of the labor force, people who are either employed or looking for work, that don't have a job, okay? And that's one way to look at things. So imagine somebody who lives in Lawrence, because it's a great place, but that person works in Kansas City, and their spouse works in Topeka, okay? Those two people would show up in the Lawrence unemployment rate number. But in terms of jobs, which is based on employers, businesses, they would show up in the Kansas City and Topeka employment numbers. Okay? So you in particular can be especially affected by that here in the Lawrence area. But everywhere we see some differences in terms of what goes on with the jobs numbers versus the unemployment rate numbers. And so this figure, this chart, shows we started at January 2020, and I wanted to see what happened during the pandemic and how far back have we come in terms of total number of jobs in the Lawrence metropolitan area, the Kansas City metropolitan area, Topeka, and the United States as a whole. And what you can see is the total number of jobs in Lawrence has not recovered to the same degree as those other markets. You're still down about 6% compared to where you were at the beginning of January prior to the pandemic. So there's still room to grow. But there's an interesting subplot here that I didn't expect, and I actually kind of became aware of this on Tuesday, and I said, oh, I need to add that to my presentation for Lawrence, which is that when we measure the unemployment rate, okay, we are measuring households, and we actually go and we ask, we have a number that is total number of people employed based on that household survey. And then we have the total number of people employed based on the establishment survey, or businesses. And so I decided to take the same thing for Kansas as a whole and look and see what's happened with the number of people employed based on that unemployment rate survey versus the number of people employed based on surveying businesses. And you'll notice that there's a real sharp difference. If we look at households, the number of people who are working, who have a job, has fully recovered in the state of Kansas compared to the pandemic, after the downturns from the pandemic. On the other hand, when we look at the establishment survey, the businesses, it seems like we're still almost 4% down compared to where we were at the beginning. Now, what causes this? This, I don't think, is related to people just are working over in Missouri, and so they get jobs, all the jobs are over in Missouri. I don't think that's what's going on. But a broader question might be, I've been a little bit skeptical of the, remote work is here to stay. I mean, there's some elements that will be, but we'll never go back to the office again. I don't think that that's going to be a realistic outcome of all of this. And I've also been highly skeptical of people saying, everybody's going to move to Kansas now because, it's so cheap and wonderful to live here, and now they can work at their job in New York or Chicago. And so now they'll move here. I'm wondering if some of this might be, whether it's people moving here or more likely people who are here who have accepted remote jobs in other parts of the country. It's too early to say what exactly is happening here. It's also possible it's just a statistical anomaly. There's a lot of estimation that goes into all of these things, but it's that's a big difference that we're seeing there to be a statistical anomaly. You might be asking, is this true for Lawrence as well? And the answer is it's not as extreme, but yes, it is true for Lawrence. Number of jobs, number of people working from the household survey, you're down only about 2% compared to where you were prior to the pandemic. Whereas with total jobs, like I said, you're down about 6% in the Lawrence metropolitan area, which is Douglas County. Okay? So let me pause right there and just see if anybody, I'm going to get a drink of water, but then I'll see if anybody has any questions, because I want you to interrupt me and stop me on these things.
With the idea that the students that were here and then went home when they were working, could that have some effect?
So the question was, would the idea of a student who worked here and then they went home, but they continued to work at their job that was here, that would actually kind of work the opposite because they would no longer be physically here. Students are always a little bit of a challenging piece with that, but I don't think students would be explaining that. And again, it's not just Lawrence; it's bigger for the state of Kansas as a whole than it is for Lawrence. So, kind of interesting, isn't it? Yeah, back in the back.
I'm going to try to talk loud. In your research, have you figured out what is the barrier to getting people who are not looking for work to start looking for work again?
So the question was, in my research, have I looked at how we get people who are not looking for work to look for work again? And my suspicion is this is related to the question of the extended unemployment rate benefits and the feeling that people have left the labor force as a result of some of the support that's been provided for the pandemic. I've generally been, look, we can point to anecdotes of all sorts of situations. And we need to be careful about looking at anecdotal examples of people. I mean, are there people out there who, wow, I'm getting paid to not work, I'm going to stay at home? Sure. There are people out there who are doing that. Is that the driving force behind the lack of the labor supply issues that we're facing? I don't think so. I think most people do want to work. They want not just for the money, but to feel productive, to feel like they're contributing and they're doing something meaningful. There are mismatch problems that we see. So I talk to young people, and if you go and talk to some of the students at the university and recent graduates, they'll talk about, I understand this is supposed to be this fantastic labor market, but why can't I find a job? And there is this real challenge of matching up the skills and what people need with the skills that people have. And so it's just something that's going to take some time to work through. I don't think that was a really great answer to your question. But there was one other thing I wanted to touch with that, which is that I do think that sometimes some economists get very focused on the population, the employment to population ratio, as opposed to the unemployment rate. So that's the number of people working compared to the total population, okay? And they think that, as you raise that employment to population ratio, that's a good sign, that helps grow the economy. Well, in a measured sense, it does. But when you have a two-income household and one person then stays home to take care of the kids, that's economic activity. That's important things that are going on. It's not measured in the economy. Technically speaking, if both of them stayed employed and they put the children into daycare, that would have been an economic stimulus. But it wasn't necessary. But in functional, reality, that was just a shift in where that economic activity really occurred, even though we don't measure home production very well. And so I think we need to value and appreciate the opportunities that we have, and then say what are choices where households make to say, what, it makes more sense for me to be staying at home or for working full-time or part-time or whatever. That's a good thing. I think I saw a question up front and then another one in the back. Yeah.
Yeah, I was wondering if there's some kind of survey, or maybe it's less high school or college kids actually working since the pandemic?
I don't know the answer. So the question is whether or not there's been an issue of high school students and young people, fewer of them working. And the data is there. I just never looked at that breakdown. So I really don't have an answer to that question. I'm sorry. I saw one more question in the back. Yeah.
So breaking this down by industry, are there attritions that are more higher in other industries than others, so like retail, manufacturing, are we seeing attrition?
So the question is, if you break this down by industry, are there differences that we see in terms of the employment numbers and so forth? And we get that data from the establishment survey, because that's where we have industry codes and we know what jobs, where people are working. Yes, there are just very big differences, and of course the leisure and hospitality sectors have been really hit by the pandemic. Manufacturing in many cases have been hit by the pandemic. This is a place where I'm going to say you want to go and look at the Center for Economic Development and Business Research, so CEDBR.org, Center for Economic Development and Business Research. They just released, what a transition, their employment forecast for the state of Kansas, and I have those numbers here, but they actually do detailed breakdowns in every major sector across the state. And while they don't forecast Lawrence metropolitan area specifically, they do separate forecasts for the Kansas City metropolitan area and for the Topeka metropolitan area. And so if you go to their website, you can see their latest forecasts and you can get detailed data on breakdowns by industry. And they also have tools on their website to provide things like retail sales activity, population forecasts, all broken down at the county level by the state of Kansas. So a wealth of data there that I'd encourage you to take advantage of. And so, yes?
Just real quick on the last slide, was there any correlation
Again, there are detailed data in terms of those types of issues. Those tend to come at a much lower frequency. You get surveys that maybe happen quarterly or other times in order to really get the detailed information. The more detailed information you want, the longer you have to wait to get it. And I'm not a labor economist, so I don't dig deep into those nuances across those pieces. But again, if you want to go look at some of those numbers, the Center for Economic Development and Business Research has all that data, and so it's a great resource for you.
Dr. Longhofer,
Yeah.
before you shift off of that slide appears to be reversed from the trend for the state. In other words, in the trend for the state, the household survey was near 0, and the establishment survey was some place around point.
So the basic idea, you know what? That is correct. That is the right thing. And I think that's the same basic picture, right? The green line is the household survey. The blue line is the establishment survey. And the green line is above, meaning that households have recovered more. People, when we call people and we ask them, do you have a job? We're in Kansas, we're more than back to the number of people working from that survey. Whereas we're about 4% down compared to prior to the pandemic when we look at businesses in the state of Kansas. In Lawrence, the numbers are all lower, but this pattern is the same. The households have recovered more than the jobs at businesses have recovered. So, yeah. So what is the employment forecast for Kansas? The state of Kansas, the Center for Economic Development and Business Research is forecasting that total employment will be up to about 1.375 million this year. That's about a 1.2% increase. And then another 1% increase next year is what they're forecasting. That's strong employment growth for Kansas, but you really have to keep it in perspective because it's still far below where we were back in 2017. And so we still have, there is still, in terms of just domestic economic activity in the state of Kansas, we have a lot of room to recover still. I thought you might be interested in knowing what the Kansas City forecast is, so I included that here as well. I probably should have included Topeka, but I didn't. And Kansas City's forecast is even stronger. 2.6% recovery this year and 1.5% next year. And you'll notice that the 1,094,000 jobs next year in the Kansas City metro area, that is above the 2018 level. So it's really almost recovered to where we were prior to the pandemic is what the forecast is. So again, Kansas City is chugging along really, really well. And that's going to obviously bode well for the Lawrence metro area. So when I look at the housing forecast, the fundamentals, I look at the jobs and do people have jobs and what's the employment situation, and then I look at mortgage rates and what's the availability of financing and the cost of financing. And the Mortgage Bankers Association, this chart has actually been updated from what's in the forecast itself because data gets updated. And they're now forecasting that the 30-year fixed mortgage rate will rise to about 4% by the end of next year. Now, I know I see a lot of you smirking because every year the Mortgage Bankers Association forecasts that it's going to go up. But if you remember 2 years ago, when they weren't forecasting it would go up. They were forecasting that it would stay flat at around like 4.1%. It's the same basic rate. The point at which they're forecasting has been the same all of these years. They think that mortgage rates seem to be expected to settle out eventually at around 4 to 4.5%. 4.2 actually is their forecast for the end of 2023. And so I think that, to my view, the low 4% is the very bottom end of what we should expect to see of mortgage rates in a market where there's nothing really strange going on in financial markets and the economy is fundamentally healthy. When I think about what should be built into mortgage rates, You have a real rate of interest that is based essentially on the growth rate of the economy. Then you have to build in an inflation premium to protect lenders against the purchasing power. Let's call that, the Fed's target for that is about 2%. So let's take 2% growth rate plus 2% there. And then you have to add a premium for mortgages compared to a riskless security. And so maybe add another 1%, 1.5%. You know, fudge those numbers a little bit. I think 4.5% to 6% is a very reasonable range for 30-year fixed mortgage rates when the economy is growing well, the Fed is not overly involved in mortgage markets and doing strange things to financing, inflation is low and steady. When we are in that situation, which I've been saying now for about 12 years, we'll get to eventually, but when we're there, I think that's the range of mortgage rates that we'll see, and that seems to be, you know, Mortgage Bankers Association, I think, is agreeing with me, but maybe on the lower end of that. So, does that make sense? So when will mortgage rates rise? You know, this 3% rate that we have right now is just absolutely amazing. It's incredibly low. You have to take the mortgage rate situation that we have right now in the context of the extraordinary actions that the Federal Reserve has been taking ever since the onset of the financial crisis back in 2008. This chart shows the holdings of mortgage-backed securities directly by the Federal Reserve. And prior to 2008, the Fed did not buy mortgage-backed securities. They simply bought Treasury securities, mostly short-term Treasury securities, but of different terms. And then in the wake of the financial crisis, they began their activities that we call quantitative easing, where they were purchasing long-term Treasury bonds and other long-term securities, including mortgage-backed securities. And you'll notice that the axis here on the left is trillions of dollars. And so over the course of the 2 years after the onset of the financial crisis, the Fed increased its holdings from 0 to over $1 trillion in mortgage-backed securities. That's a huge increase in holdings, and that had a big impact on driving mortgage rates down to where they have been all of the last decade. They began tapering off a little bit in the early teens, but then picked up again, and they stabilized at around 1.75 trillion through most of the late 20 teens. And finally, in 2018, they began to slowly let that taper off. It was basically when a mortgage-backed security would mature, they would not buy a new one to replace it. And that was a slow tapering process. Well, when the pandemic hit, they doubled down their efforts, and now their holdings are about $2.5 trillion worth of mortgage-backed securities. And that's why we see rates lower now than we saw at any time in the wake of the financial crisis. They have begun discussions of tapering, and I saw just this morning, you know, that they released this week the minutes from the Fed's September meeting, where you kind of get some insights, and the Fed is beginning to have some concerns about an increase in inflation being more than transitory. Matter of fact, I saw a quotation from actually a co-author of mine. He's the president of the Atlanta Fed, Raphael Bostic, and he made comments that he hates the word transitory inflation because it's you know, dropping dollars into a jar. It says, you know, once that dollar purchasing power goes away, it's gone. And I would never disagree with Raphael. He's one of the smartest people that I've ever known. But you know, what do we mean by inflation? What really is inflation? And I think this is important. We have had a big uptick in the price level, especially due to the surge in demand as we came out of the pandemic, and also in response to the supply chain challenges that we've had. And so this chart has a lot of lines on it, but all of them tell a story. So bear with me, and I want to explain it. The pink line is the headline inflation number that most of us see. It's the year-over-year change in the consumer price index. And as you can see, it's the one at the very top at the end. Our latest numbers with that are just over 5% increase in inflation. And you may have seen the headlines that Social Security benefits are going to go up by, 5.6% or something like that. 5.9 is what it was, so my mom will be happy with that. Now if only we could convince the state legislature to include a cost of living adjustment for state employees, right? So, sorry, just a very self-serving plug there. But that actually gets to the fundamental question of whether something is a one-time blip or whether it is a sustained, embedded increase in the inflation rate. One-time changes in the price level do not necessarily equate to inflation. Inflation is a consistent increase in prices over a long period of time. And one of the ways that happens is when businesses and households become acclimated to expecting that inflation is going to be higher, and therefore begin altering their purchases and their economic activity. We start building in an expectation of 5% wage increases just to account for inflation. We start building in an expectation that we're going to be increasing our prices to our customers based on inflation that will be built in. That's different than one-time price shifts. We've seen price shifts in building costs and in other things that over time, and those haven't been embedded into the economy, resulting in long-term increases in the inflation rate. And so one measure that we look at to think about this is a survey of households. And the blue line on here is the survey, it's a survey done by the University of Michigan of households across the United States. What do you think the inflation rate will be in the coming year? The pink line is what was it last year. The blue line is what do you think it will be over the course of the next year. And you can see that households are expecting the inflation rate to be just under 5% next year. Now, I will say that the households have a tendency to basically look at the current headline inflation number and report that. If you take a longer survey back, if I showed this, ran this slide back, say, to the 1990s, the household survey pretty much runs in lockstep with the overall consumer inflation rate. When inflation is especially low, like it was in the mid-teens, 2015, 2016, households don't believe that that's permanent. But for a general rule, they tend to follow whatever happens with the overall inflation rate. And, households are just, hey, you got a phone call, you got a survey, you just answer the question, what do you think inflation will be? And you answer. Okay, great. The orange line, however, is particularly interesting. This is a number called the 5-year break-even inflation rate. And how many of you have ever heard of TIPS securities? Treasury Inflation Protected Securities. They were created back in the 1990s, and they are U.S. government bonds. And just like any other government bond, they pay you semi-annual interest, and then at the end of the term, if it's a 5-year bond or a 10-year bond, at the end, you pay back your principal, the face value of that bond. What's different, however, is that every single year, the TIPS security at a designated point goes and says, what was actual inflation over the past year? And then it increases the par value of the bond based on actual inflation that occurred. So if you had a 5-year TIPS security, and that security this year, inflation was 5%, and it had been a $1,000 par value bond, its par value now increases to $1,050, a 5% increase, and now the interest that you get on it is based on that new $1,050, and when it matures, you will receive that higher amount. So these TIPS securities embed inflation protection into them. since you're protected on the back end from actual inflation that occurs, you don't need to build in an inflation premium in the interest rate that you demand from it. And so what the Fed does is they go through and they look at the regular Treasury security that doesn't have this feature, and the TIPS security, and the difference in the interest rates on these, and they tease out the implied inflation rate that investors are expecting, in this case over the next 5 years. And what you can see is that this TIPS, this break-even rate has an expected inflation rate over the next 5 years. I just looked to see the daily numbers. The most recent ones are about 2.6%. And that's an average rate over the next 5 years. Now, what is really important to understand about this is that I think of this as a little bit like looking at the Vegas betting line. Okay, I think the Chiefs have like a 7-point favorite for playing against the Redskins this weekend, and none of us wants to make a bet on it right now. But the point is, you may believe strongly, oh no, they're going to tank it, or they're going to do great, they're going to win. That's fine. What the Vegas betting line is doing, they're not predicting the game per se. They're simply trying to balance out the money on people who will say the Chiefs will win versus the money of people who say that the Redskins, wow, it still is embedded in the Washington football team, and that the Washington football team will win, and those and all that point spread is doing is telling us what's the balance of the expectations in this market. That's what this break-even rate is doing. It's not saying that they're right, but we can use this as an estimation of what do financial markets believe. On average, if you look at all the investors out there who are putting money down on this, what do they believe inflation will be? And they're believing that it will only be a little over 2.5% over the next 5 years. This is something that I look at that says the recent uptick in inflation due to supply constraints and the supply chain issues, which are going to take some time to work through. It may be that we have higher headline inflation numbers for the next year or so, but this is not something that has yet become embedded where financial markets are expecting it. Does that make some sense? Okay. Well, what then does all of this mean for housing markets? This slide shows the Lawrence home sales activity, and I typically use here the Lawrence metropolitan area numbers, which is essentially all of Douglas County. And we can see that home sales activity has been, the blue bars are actual home sales numbers that are reported by your multiple listing service, and then the pink line is a moving average that gives us a sense of kind of what are the underlying trends. And essentially, we've been fairly flat over the last couple of years. And this is in contrast to other markets across the state where somehow people continue to find new homes to sell despite the lack of inventory. By the way, I saw some of you taking pictures. Wonderful. You're welcome to do that. Tweet away or save it for your own reference. But if you want copies of my slides, they are available right now on the Center for Real Estate website. If you go to wichita.edu/real estate, on the right-hand side at the top, you will see a link that says Lawrence Housing Forecast Presentation. And that presentation is right there. It actually, I think, will go away here at about 11 o'clock because it won't go away, but it won't be the main one on there because I'm headed to Salina here shortly. And the Salina presentation will show up there. But if you go to the Lawrence Housing Forecast page there, all of the presentations related to the Lawrence forecast will be located there. So you can download all the slides there. Meant to say that earlier. So our forecast for Lawrence home sales activity is essentially flat over the next couple of years. A slight decline this year and maybe a slight increase next year. Total sales next year we're forecasting to be 1,600 units. And again, this is for all of Douglas County, the metropolitan area. And the reason for this lackluster forecast. It's not a bad forecast. These are good numbers, and you guys are working hard, and it's good number, but not a big increase, is due to the lack of inventory. There's just such a shortage of homes available for sale that it's making it really, really difficult to find homes for people who want to buy them. And so again, this is the month supply. We take the number of homes that are actively listed, and we divide it by the average pace of sales over the prior year. And so if you look at, so for instance, if say there were 1,000 homes on the market, and we were selling on average 200 homes a month, then that would be 1,000 divided by 200, a 5-month supply. We normally think of a balanced market as one in which we have a 4 to 6 month supply. Well, Lawrence, by that definition, Lawrence hasn't been in a balanced market since 2014. And one of the things that I think is really important when I get calls from reporters or other people, and they've been really fascinated by the housing market over the past year, and I said, this is not a new story. This has been building and coming for a long time. And now, with month supply, it's just over a 1 month supply in Lawrence. I mean, that's just absolutely ridiculous. I think I was looking at some of your latest statistics, and I didn't pull them up here with me, but I've seen median days on market was running just a few days. And it's like 4 or 5 days, median days on market. Average percent of list is well over 100% of list. On average, I mean, just really remarkable at how the market is moving. So very, very tight inventories, tighter than the rest of the state. And what's been, like I said, this has been a relatively consistent. Yeah.
What markets are doing well compared to us? Because I hear Topeka is crazy.
Yeah, Topeka is having increased sales. Kansas City is having some increased sales. Wichita has had remarkable increased sales. I'll show the summary of all the markets across the state here at the end. And actually, in the back of your forecast is a summary of all of the markets in the state as a whole. You're going to put me on the spot here, and I'm going to say something wrong because I'm not going to, there are too many numbers floating around in my head. You won't believe this, but I'm actually really terrible with sort of just pulling statistics off the top of my head. I need my cheat sheet. So the thing that has been relatively new recently has been the change in market segments, and in particular, the upper end of the market. And this is not unique to Lawrence. This is in every market across the state. For a lot of years, we've been saying, those homes that are in the real sweet spot, 150 to 300,000. By the way, I chose these cut points arbitrarily. I just said, what would be a low-end house, kind of a middle-end house, kind of upper middle, and then a high-end house. And you can quibble with the breakpoints. That's fine. The orange line, however, are homes that are listed with prices above $500,000. And of course, we've been flush for years. And there's a lot of seasonality in that, but we range between 8 to 16 months supply for a lot of time. Just upper end of the market is different until now. And now, all of a sudden, the month supply for homes listed in those price ranges is down to below a 4-month supply, maybe around a 3-month supply. I don't have my exact cheat sheet number on here. And again, this is true across the entire state. And so that's been really, really remarkable over the past 2 years is where we've really seen that change. Well, when you have home sales activity, and now I'm looking at this, and I am pretty certain, let me look. Now I need my cheat sheet. So, I think I have a typo on here. I copied over a piece. Yes, I have a typo on here. This is actually the Lawrence home prices forecast, but I didn't change when I used a slide as a template. I didn't change it over. Oh, the shame. Forgive me. When you have really, really tight inventories, and when I said we're not forecasting home sales to increase very much, pretty flat over the next 2 years, it's not because of a lack of demand. It's only due to the lack of inventory. And so when you see a really sharp lack of supply, then that means home prices are appreciating. And home prices, I don't have the second quarter number right here off the top of my head for Lawrence, but home prices in Lawrence over the last 12 months have been appreciating at the fastest pace on record. And we think that that's, we're right now we're on pace to end the year with Lawrence home prices up over 11% compared to the prior year. And that's going to taper off a little bit next year to the slow rate of 6.7%. 6.7% is really fast appreciation. You see that sometimes in Lawrence in the past, but that's an aggressive appreciation rate. And quite frankly, I don't see a lot that's going to cause home prices appreciation to slow down anytime in the foreseeable future. And one of the reasons is because of construction activity. And this is one area where Lawrence does differ a great deal from the other parts of the state. New home construction activity has really just been flat. There's not much new activity that's happening, whereas in other markets, we're seeing really sharp increases that are responding to the tight inventories, the underlying home price appreciation, and the lack of supply that's out there. Our forecast for Lawrence is once again basically flat, 280 units this year, 275 units this year, and it's really being driven by a lack of inventory. You just don't have the buildable lots, and couple that with labor supply constraints and building materials, it makes it really difficult. Yes?
How did you figure 2022? I work in new construction, and to me, I don't believe that number. It has to be worse than that.
Well, so how do I come up with these numbers? All these numbers. We do statistics. So basically, I take monthly building permits, same thing with home sales, and quarterly home price appreciation. I take these numbers and I run statistical models that basically look at past trends and how movements have happened in the past. I do build in some things about employment forecasts and what's happening with home sales activity. And the one thing that those past statistical models cannot take into account very well is going to be when you take a very severe hard left turn, right? Statistical models just can't predict that. So if you tell me no way that's going to happen, I would say, let's talk about that, and I want to hear why you're thinking about that. But based on the trends that we've seen, we're not seeing anything that's going to push that up, okay? And one of the things to remember is that this is the metropolitan area, and so it's not just the city of Lawrence, but all of Douglas County. And so that does make a difference in these things. There are other areas in Lawrence in which you can build, in Douglas County in which you can build. However, just because you're able to build in other areas doesn't mean that's where the buyers that are looking to buy want to be, right? And so that becomes a challenge in those things. Did I see another question over there? Yes.
Okay, so we look at Lawrence and why new construction is so flat and or down compared to 2018. You have other communities like the Kansas City Metro, you have Topeka, and Lawrence, because of regulation, because of the lot issues and not having it, they're actually causing a perfect storm. We have low inventory anywhere from on the resale homes, and now we have really hard to get new lots and be able to build. So they're causing this what I think somewhat is an artificial, it could have been corrected had they been looking forward. So do we take and look and see what we can do to help Lawrence out? Because at this point, I just see it continuing for a long time, and it's just going to get worse.
Certainly, the only thing that's going to resolve the supply constraints that we have is new construction. And like I said, this is not something that happened overnight. And this is not something that's necessarily unique to Lawrence in terms of these tight inventories. We've been underbuilding new single-family housing in the United States for about 12 years now, ever since we came out of the financial crisis. And so that, we need to see a lot more housing that's being built. And sometimes you say, well, wait a minute, we've got this housing, we've got buildings that are there. Housing that isn't what people want doesn't resolve the supply constraint. And so some of that may be renovation and remodeling existing housing. Some of it may be tear downs and building new, but quite frankly, that's far more expensive than building new housing on the periphery. And so it's going to be difficult to manage it just through infill development, if you will. That's a part of the whole thing, but that's not going to be the only piece. Yeah.
Do you think that's also helping with, since we have these low inventories, and I know this seems like a common sense question, but maybe not to all, but because we have such low inventories and new construction, do you feel that's also escalating our prices and
Oh,
costs?
absolutely, absolutely. I mean, home price appreciation across the state is going up at a historically rapid pace because inventories have been declining for, again, 8 years, and we haven't been building enough new homes for about 12 years, so those two things have been combining to increase home price appreciation. What's different in Lawrence compared to other markets is that other markets are showing rapid increases now in new home construction to try and help rectify it. But it's going to take years for that to recover, even in Kansas City or down in Wichita or in Topeka. And so we're expecting home price appreciation to continue at a very, very solid pace for the foreseeable future. And I think it could be even stronger in Lawrence as a result of the lack of building right now.
Do you have a calculation for like affordability of houses within communities? Do you make that calculation to say, in this market, based on what employment and what their salaries are, this is what an affordable home approximately should be for that market?
The National Association, so the question was about, what is housing affordability and how is that affected? The National Association of Realtors puts together a housing affordability index. And what they do is they look at mortgage rates and they look at income levels in each community. I think they release this quarterly for every metropolitan area, well, large metropolitan areas. Lawrence may be too small for them to report, are they?
Yeah.
You can at least look at Kansas City. And then they look at family income. And so they ask, what would be the income that you would need to qualify for the payment, given current mortgage rates, on a 30-year fixed rate mortgage for the median sale price home in this community? And then they say, how does that compare to the median family income? And that gives them their index of affordability. You could calculate that number for Lawrence. It just wouldn't be at the same frequency. Again, the smaller the community, I said that the more detail you want, the longer you have to wait. Part of that detail is smaller communities, and so you have to wait longer to get that median family income, which is why it's not included with the NAR numbers. I'll just mention the National Association of Home Builders also has a number that they call the Housing Opportunity Index. It measures a similar concept, but instead it asks, what would the median family income, what percentage of homes for sale in the market would they be able to purchase? So a similar measure. The thing that's keeping housing affordable on those measures is the low interest rates. When mortgage rates go up, which we've been saying it will happen for a long time, so we'll see. But when those mortgage rates go up, going from 3% to 4% isn't going to have a huge impact on affordability, but it will have an impact, and it will especially have a big impact on those that are at the lowest income segments within the community. Yes?
So when you were talking about communities where they are having an increase in new construction, do they have the lots, or are they annexing land in? Because one thing that you're probably not aware of is that in our new strategic plan of 2040, any new land that's annexed into the city has to come with community benefit. And so that is deterring growth and going to cause house prices to be even more expensive. So I'm wondering, in those communities, where's the new construction happening?
Well, I can speak real clearly to Wichita, and I can speak a little bit to Kansas City. Wichita has very little constraint to annexing. The city of Wichita has taken a view that new developments, I remember a former city mayor was talking to me and commented about, for all the issues and challenges that people have, new developments pay for services to the rest of the city.
Right.
You have these high property taxes, and that's not where we're having our police calls. That's not where we're having our fire calls. That's not where we're having to go back in and repair roads and repair water lines and repair the sewer lines. If we didn't have the property taxes from the new developments, we wouldn't be able to afford to service the rest of the city. And there's actually a lot of research in public administration and urban growth that there is kind of an optimal growth rate for a city in terms of adding new developments to be able to help provide support for the existing. Part of that plays into that is that new developments in most communities across the state are expected to pay for the infrastructure they put in. Now, the place where the calculus really gets mixed up is when you run into capacity constraints with respect to public services. So if it's just adding more roads and sewer lines and those things to an existing infrastructure that's already there, that's generally able to be captured within that new development. But if all of a sudden you've got to add a new pumping station for the sewer because you're now past a ridge line and unfortunately sewer does not flow upward, or maybe fortunately, then all of a sudden you do have a big cost that's associated with that. And there's a balance in figuring out how you measure all of the costs associated with new development and make sure that that's all captured. But it is important that sort of in the regular operational costs of the city, new developments tend to be very low cost for the city once they're online. So, Kansas City as well, it's again, we're talking metro area here, not just the cities. But there are communities that view this as the way they grow their tax base. Ultimately. Right. I thought I saw one other question over here. Did I? So, well, that essentially is our forecast. Like we said, we think home sales will be basically flat over the course of the next 2 years, this year and next. Single-family building permits not really moving anywhere, and as a result, home prices are blasting off into outer space. We do have our Kansas housing forecast, but I wanted to actually go forward here because I do have my slide for the major markets forecast, which is back there, and take just a moment to kind of talk about what we have here. Kansas City is just going gangbusters, and 5.9% increase. You'll see years where you see much stronger increases in home sales activity, but they're able to deal with that issue somehow in terms of the supply constraints. Manhattan, wow, they were really limited for a number of years. Part of what's going on in Manhattan is that for a lot of years when everybody else was really continuing to increase, Manhattan was kind of flat, and they've taken off over the past year. Topeka is relatively flat in their home sales activity. Supply constraints are the issue there, and Wichita, again, really solid growth. But it's the building permits activity that's really going to make the difference long term. Kansas City, of course, just exploding. But even Manhattan, Topeka, and Wichita are all seeing some pretty solid growth over the next year. Yeah?
Do you look at economic development as a driver for the housing sales also? When a city has great economic development, like Topeka, I know they're really having a push for economic development there, and so is Manhattan. Does that also help drive the housing market to increase their sales?
So certainly economic, when you have businesses that locate in a community and create new jobs, and then people move to the community in order to take those jobs, then obviously that increases your housing demand, right? But the thing to recognize is that economic development is a long-term issue, and typically the impact of it is outside the framework. And I'll give one example, which is the NBAF over in Manhattan, the National Bio-Agro Defense Facility. That was predicted to create all this huge number of jobs and lots of companies and all sorts of things, and it is still yet to really take off. And so, in terms of the real economic impact that it has. So, and of course, the bigger the community is, the less it takes something really major to have an impact on those things. So, a new company that comes into Wichita, which they would love to have, that brings in 200 jobs, well, that's just not going to have a measurable impact by the time you get down to the housing market there. Other questions? Well, I want to thank you all so much. It's so much fun to come here. You ask great questions. You're always very engaged, and it's my great pleasure always to come up. Please invite me back. And once again, I want to give a big thanks to Security First and Ameritrust. Take copies of those forecasts back with you. Grab 2 big arm loads and take them back to your office. And again, distribute them, because that's what they're there for. And you know, the beautiful work here couldn't do if we didn't have the support from Security First and Ameritrust. So thank you all very much.